Welcome everyone to Vested Interest. In this video, we will cover our portfolio update. We do this every week on Sunday morning. We did add $1,601 in new capital to the portfolio. We will cover any dividends we received, what positions we added with those new funds, and any options we were in. It's not been a great month or a great start to the year for options overall, but we will cover that from week to week. But before we get in the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the video, and special thank you to those who subscribe to the channel. I really do appreciate it. And for those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with a positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilize both a dollar cost average approach, a DCA approach, consistently investing in the portfolio on a weekly basis, and that's what this video is. We're going to cover our weekly portfolio investments. I also do larger purchases if I have extra funds from a bonus from work. I do work every day. This is not my full-time job here on YouTube. I actually don't make any money from YouTube. So a bonus from work, or if I do a side job, something along those lines. So I'll cover any of those investments, large or small. And it is free to see what I'm doing in the portfolio every week. I don't have a paid Patreon account. I'm not trying to get you to sign up for any websites or anywhere else, send you to any other sites to see what I'm doing. Sign up for my weekly newsletter or anything like that. So if you want to help out the channel, if you could do me a big favor, hit that thumbs up button down below if you find any value in the content. If you're a dividend growth investor, make sure you hit the subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Click that subscribe button down below. Hit the notification bell so you're notified whenever we put out any new content. Again, I do this portfolio update video every Sunday morning. I also do a stock pick of the day series Monday through Thursday whenever the market's open. We take a look at a company's stock that's pulled back on the day, run it through a screener and see if it makes it onto my watch list, if it's presenting any undervaluation. So again, hit that subscribe button, hit the notification bell, hit that thumbs up. It doesn't cost you a thing. It really does help out the channel. And there is the thanks button down below for those of you who are interested and available. You can buy me a cup of tea there. I don't drink coffee. It gets me pretty wired. So for those of you who do drink coffee, that's great. But I'm more of a tea drinker myself. And appreciate everyone who's taking the time to do that. And again, special thank you to the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Now we're going to kick off with the options for the video. It has not been a good start for 2025, as I mentioned in the opening slide there. Really, I'll be honest, it's been a crazy market. The market's up one day, down the next. Seems like what we were on was a little bit of a downtrend there, and then all of a sudden, midweek this week, it really started shooting back up. I had positions jump up 5 to 7% after dropping 5 to 10% or even 10 to 15%. So crazy market to start the year. Seems like I'm going in the opposite direction. Whenever I throw out options on positions, they're running up whenever I think they're going to go down, or they're going down whenever I think they're going to run up. No one really has bought on any of those that I've sent out. I still push out 4 or 5 different options plays every week. Just have not gotten anything. I will say I am not as focused on it as I was last year, even though there's more volatility, and I think options plays are good to run whenever there's volatility. I am very conservative on these, so a lot of times I am trying to keep the positions that I have while also collecting those options premium. Some of you may not care if they're called away. I kind of do care. Like I said, I like the positions I'm in and would like to hold them long term, so it's just a way to generate extra income, but it just has not been a great start so far. Now, dividends. Now, it has been a better start for dividends. I will say we did receive our first dividend of the week on the 15th. Realty Income, ticker O, paid us $69.73. We do have the drip set on the portfolio. And for my overall brokerage account, I use Ally Bank. It's also who I do my regular banking, where I have my savings, my checking, everything with Ally. I'm not affiliated with Ally, but since I use them, I will plug them a little bit here. But on my positions, I only can do all or nothing. I know there's some other brokerages out there where you can set individual positions to have the drip set. And when I mean positions, I'm talking about the drip, dividend reinvestment plan. So I have all of my positions set to reinvest the dividends whenever they're paid out back into that position. That's what the DRIP stands for. If you hear someone say that, it stands for Dividend Reinvestment Plan, DRIP, DRIP. So Realty Income paid us $69.73. That $69.73 went right back into Realty Income, picked up 1.29441 more shares of Realty Income, and those new shares, well, one share in fractions of shares there, adds an additional $4.10 over the next calendar year. And that is also what's referred to as the dividend snowball, right? I've already added capital and bought shares of Realty Income. Those shares pay out dividends. Those dividends go back in, get reinvested, buy more shares, or like I said, one share in fractions of a share in this case. And those new shares add additional passive income. That's the dividend snowball or compounded interest in effect. So even if I don't add any additional capital to Realty Income, which I'm looking at it right now, I'll probably be adding a little bit next week maybe. If it stays below my cost basis, it's pulled back significantly right now. So even if I don't add to Realty Income, it will continue to grow over time as it pays out dividends every month. And the dividends kept rolling in. On the 17th, we received $41.57 from Owens Corning, ticker OC. This is out of the industrial sector. Realty Income was out of the realty sector, real estate sector, if I didn't mention that on the previous slide. Owens Corning paid us $41.57. Again, the drip set on all my positions. I can't do individual positions there, so it's all or nothing for my portfolio. So this $41.57 goes right back in. Picked up 0.22779 more shares of Owens Corning. That added an additional 62 cents there, a whopping 62 cents in additional passive income over the next calendar year. Now we get into the new capital added on the 13th. I went in on Monday and added $1,102.44. With those funds, we continued to add to our Lam Research Corporation position here. We added 2 more shares to ticker LRCX. This is out of the information technology sector. Picked up those shares at $72.88. I think this was a little over 80 by the end of the week, so I was glad we jumped in on Monday and added here. We added more to our Occidental Petroleum position here, ticker OXY. This is another one we've been adding to for the month of January. Probably will continue to do so here. Might back off on Lam Research now that it's over my cost basis a little bit. I have over 130 shares there, so it's pretty well built out. I was trying to get over 100 shares. If it dips back below my cost basis, I might add some additional. Occidental is actually over my cost basis right now, but I want to build this to at least 100 shares. I'd like to get, $5,000-$6,000 invested in this one while it's under the mid 55 range. Picked up those shares at $52.04. I think this one was actually down below $52. Might have dropped into the 51 range. We'll see that here at the end. But we're going to continue adding to that one. Owens Corning there, you saw it paid out dividends. We added 2 more shares there. Ticker OC, out of the industrial sector. Occidental was out of the energy sector, if I didn't mention that. And we bought those 2 shares of Owens Corning's at $166.08. Again, another one that really jumped up by the end of the week. I think this was in the 170 range by the end of the week. We'll see that here at the end. And the new funds added, the $1,102.44 added. The shares it picked up added an additional $17.92 in passive income over the next calendar year. And we weren't done. We went back in and added an additional $499.10 on Thursday, January 16th. With those funds, we added 2 more shares to our Valet position, ticker VALE. This is out of the materials sector. Picked up those 2 shares at $8.72. Picked up 4 shares of Schwab's Strategic Dividend Growth ETF here, ticker SCHD. This one is a weekly buy. Typically, I do 3 shares every week. This week, I did 4 instead of the typical 3. I might nibble on it a little bit. It was just under my cost basis, so that's part of the reason there. I think this one, again, was another one that jumped up by the end of the week, slightly over my cost basis, but I really like this position right now while it's pulled back. So we'll probably add, at least 4 shares, at least 3 shares really, but 4 to 5 maybe while it's pulled back. LyondellBasell's, we added 1 more share to LYB, ticker LYB. This is also out of the materials sector here. We picked up that 1 share at $76.79. Another one that really jumped up for the week. We've been adding 1 or 2 shares here for the last several weeks. This one I may actually focus on a little more going forward while it's significantly under my cost basis. My cost basis is around $87, I think, $88 right in there. We'll see that here at the end of the video. But this one is a very high payer, dividend payer here. And while it's pulled back, I'd like to build it out a little bit more, maybe 6 or 7 shares over the next couple of weeks while it's pulled back. Excuse me. And last but certainly not least, we added to our Vanguard Total Stock Market ETF, ticker VTI, and that's exactly what it is. It is the total stock market. And this is another one, just like SCHD, we're going to add to every week, regardless of the market, at least 1 share. We picked up the 1 share at $293.82. And the $499.10 added, the new shares it picked up added an additional $15.02 in passive income over the next calendar year. Total invested this week, $1,601.54. Total passive income added with the new funds, along with the dividends paid out in the shares they picked up, $37.66 in passive income added to the portfolio. All right, let's jump through the sector weights real quick, see how this one stacks up. Communications makes up 9.58% of the portfolio. Consumer discretionary makes up 4.7% of the pie right now. Consumer staples at 8.75%. Energy makes up 7.27%. Financial sector here at 2.76. Healthcare makes up 12.13. That is the second largest slice of the pie. Industrial sitting at 6.93. Technology makes up 14.39%. It is the largest piece of the pie. I've been adding to that LRCX position. It's run up. Google we were adding to for a while. It's run up. So now becomes the largest piece of the pie just by the nature of those positions running up. HPQ is another one in there. It's really run up. I think it's in the $60 range. Now my cost base is around the $40 range. So technology overall has really shot up recently. So I'm glad I added to a couple of those positions while they were down. I'd love for them to pull back so I can continue to add, but right now probably backing off a little bit and going in a different direction in sectors that I feel like are pulled back. Materials seems to be pulled back right now. Healthcare definitely seems to be pulled back right now. Industrials is another one that seems to be pulled back right now. Owens Corning there we were adding to. I'd like to add some more to Union Pacific, but let's keep going here. Materials makes up 8.17%. Again, I'd like to add to the LYB position, LyondellBasell there while it's pulled back. So probably going to add 6 or 7 shares next week and the following, at least over the next couple weeks, to try to build that out a little bit while it's down. Healthcare, CVS is one I'd still like to add to. Johnson & Johnson, Pfizer are a few there I'd like to add to. Utilities makes up 7.87%. And REITs and real estate at 7.95%. This one is another sector I feel like is pulled back right now with the threat of rates being higher longer. Realty income really pulled back. Several other in this. I know a lot of people have been adding to Vici. That has really pulled back. A lot of companies in the REIT sector right now have pulled back. So it might be an area that you take a look at. And ETFs will eventually become the largest piece of the pie just by the nature of adding to SCHD and VTI every week. So that one eventually will take over the overall portfolio. Just the nature, like I said, of adding to it, regardless of the market, we're going to add to SCHD and VTI every single week. Over here to the right, you can see those sector weights breakdown. Again, the percentages match up to the pie here, and then the dollar amount allocated to each sector as well. Now here it is, and I show this every week. I think it's important for you to see a real portfolio built out over time, especially some of you newer investors or investors out there who are potentially on the fence about investing, haven't started yet. You can do it, right? I am not a financial guru. I did not go to college for this. I did not come from a wealthy family where they turned over a bunch of money so that I could invest, or a portfolio in general. I'm learning this along the way. That's why I'm sharing my journey. Hopefully you can learn from some of the mistakes I make, and don't be scared about those mistakes. You are going to make mistakes. It's going to happen. We are human. None of us are perfect. And even the greatest investors out there will tell you there are mistakes to be made. It is the cost of doing business or the cost of education in the market. So don't be afraid of those mistakes. Just try to limit them as much as possible. For example, if you don't know a lot about investing and you want to get started, and I recommend starting as soon as possible because time is one of the biggest contributors to your overall portfolio, you can stick to index funds and ETFs. Something that tracks the S&P 500 would be what Warren Buffett recommends for the average investor. So something like VOO, which is Vanguard S&P 500 ETF. SPY, I think, is another one. There are several of them out there. If you Google, Bing, Ask Jeeves, whatever your search engine of choice is, ETFs or index funds that track the S&P 500, you'll get a list of them, and you pick the one that you like. There, like I said, are a lot of them out there. Schwab has some, Vanguard has some, Franklin Templeton has some. All of the major brokerages will have a ETF or index fund that tracks the S&P 500, or both. And the only real difference between an ETF and an index fund is harder to do options and trade in and out of, because they only, I think, sell at the end of the day. Whatever that price is locked in at what you pay or sell at. Whereas ETFs and index funds, you can trade in and out of throughout the day, right? So if you want to be able to trade options, maybe ETFs are better. If you want just something you can set and forget, and you're just going to dump money into it every week or every month, every quarter, whatever your investing schedule is, maybe index funds are a better way to go. I don't think there's a huge difference, but whatever you invest into, make sure you are paying very low fees, right? 0.06, 0.03, 0.04. There are a lot of them out there. Excuse me, you can pay zero. .0 something fees, very low fees. That's what the key, because those fees will impact your overall investing as well. So you can do it. You don't have to pay someone to invest for you. So many different brokerages accounts out there now that you can do online, do yourself, even on your phone. They have a bunch of different apps out there. You know, Robinhood, I don't really recommend that one because I feel like that's more of a trading app for traders. Webull, there's a bunch of different ones out there. You know, I would stick to a more reputable one. Like I said, Franklin Templeton, Schwab, Vanguard. Those are probably the biggest and best ones out there with some of the lowest fees. Vanguard and Schwab specifically. But anyways, let's get back to the overall portfolio. Here's the ticker in this column, total shares of each position here, current price as of the close of business, and all of these numbers will be as of the close of business on Friday. Market value here, average cost per share, purchase price, so this is how much I have into each position. This does include reinvested dividends. Total return, whether I'm up or down, you're going to see it. Like I said, I feel like it's important that you see the ups and downs of the market. Sometimes you're going to have positions run up. Sometimes you're going to have positions turn down for any number of reasons. Could be a bad earnings report, could be bad future projections, could be negative news, could be some event in the world, a war. In the case of energy stocks, it could even be a bad storm that impacts, you know, the ability for these energy companies to operate offshore or something like that. So a lot of different reasons a company can go up or down, and they are going to go up and down throughout the year for a number of those reasons. Every stock has a 52-week low. Every stock has a 52-week high. They can retest that 52-week low, set a new 52-week low, retest that 52-week high, or set a new 52-week high at any time for any number of reasons, right? So I want you to see the ups and downs of the market. Percent return here, if it's green, I'm in the green. If it's red, I'm in the negative, right? So again, I want to be completely transparent and show you some of these positions that are in the red right now. I will probably start focusing on over the next couple of weeks here, build them out a little bit while they're significantly under my cost basis. So those are the ones I look at as buying opportunities. Not the only buying opportunities. For example, we added Owens Corning. I mean, it's up 61%, right? We were buying it in the 160s. It's back up to 182. I'll probably back off on this one until it pulls back significantly again. But just because it's in the green doesn't necessarily mean I am not buying. What sector the company falls in here, quarterly, monthly, semi-annual payer, whether their current dividend yield is, my yield on cost, portfolio weighting here. So what we saw on the previous slide was each sector weighting. This is each individual positions weighting. I do have a rule in my portfolio. I don't want any one position to be more than 10 to 15% of the portfolio. I don't want any one sector to be more than 20 to 25% of the portfolio. That does not necessarily account for ETFs. ETFs, if it goes over to 20 to 25% of the portfolio, that's fine, because again, I'm going to be adding to ETFs every single week. And I do that partly for those of you out there who don't know enough about individual stocks, that you don't want to do, you know, a discounted cash flow analysis. You don't know how to look at balance sheets or income statements. That's fine. You can, again, be investing in the market without knowing any of that. Stick to a broad market ETF. I chose VTI, which is the total stock market, and SCHD, which is a dividend growth ETF. So if you want to stick to something real simple like that, you can still invest in the market. You know, Vanguard's S&P 500 would be what Warren Buffett recommends, but I didn't go that route. I went with VTI and SCHD. Those two are different than what he'd recommend, but you could go with something that tracks the S&P 500 as well and dump money into it every week, every month, every quarter, once a year, whenever you get your taxes back, whatever your investing timeline is, right? There is a way to be in the market without using a investing guru charging you fees and doing it yourself. Portfolio weighting, estimated annual income in this column, payout months here, dividend growth year over year, and where a company sits at 15% of a 52-week low. I have had some questions on this, so I'm going to talk about it just briefly here. I'm going to use Owens Corning as an example, all right? Owens Corning, follow this row over, right? 15% of a 52-week low for Owens Corning is $159.50. Currently, Owens Corning is above 15% of a 52-week low at $182.57. I added to it at $160, which was over where it sits at 15% of a 52-week low. But if you see here, my average cost per share is $113.08. That is still well below 15% of a 52-week low. I want to keep this average cost below 15% of a 52-week low. So I could still add to this even though it's over 15% of a 52-week low, over my cost basis, it will continue to increase my cost basis. And so long as it doesn't increase it over 159.50, I can still add to it. So this 15% of a 52-week low is just a high water mark. The high water mark for this position, Owens Corning, is 159.50. A high water mark of where I want to keep my average cost per share under, right? I want this average cost per share under 15% of a 52-week low. But just because the cost of the shares are over 15% of a 52-week low does not mean I can't buy them. It only matters this number. I don't want this number to be over 15% of a 52-week low. Not necessarily this number. Hopefully that makes sense. All right, let's keep going. Currently, I have 6,499.627 total shares. The market value of the overall portfolio, $322,817.54. I have $303,645.81 into the portfolio out of my pocket. When I say out of my pocket, that doesn't include reinvested dividends, because technically if I took off the drip, those reinvested dividends would go in my pocket instead. So this isn't actually dollars invested. Like whenever I show you at the beginning, I invested $1,600 and some change, $601 and some change. That's new capital. That doesn't include reinvested dividends. You saw that we did receive dividends, but that $1,601 that I say I invested this week does not account for them. This does. This accounts for reinvested dividends. So this $303,641.81 is not just new capital. It includes reinvested dividends. Total return, same thing, includes reinvested dividends. I'm going to show you whether I'm up or down, and whether I'm up or down total portfolio or individual positions. You'll see that every week. Percent return here, I don't really focus on this. It's nice to see I'm up, but I don't really care about this. If you watched the video last week, we were only up 2%. Has anything really changed that much in the market? Now we're up 6%. And this only really matters if I sell everything in the portfolio. I only lock in this gain if I sell the positions in the portfolio. I only lock in this loss if I sell Pfizer, right? I only lock in this 61.45% gain if I sell Owens Corning. So does this really matter? In my opinion, no. I am not looking at total return because I am not looking at selling out of all the positions in my portfolio. I want to create a portfolio that provides passive income so that I never have to sell the positions in the portfolio. I just want to be able to use that passive income at some point for future investments, maybe outside of the stock market, in land or real estate, for example, or to pay my bills. So that's why I am not really focused on total return, and I don't really care if I'm up or down at any one point in time. Sector each position falls in, or I'm sorry, we're going through the bottom. We already went through that. Current dividend yield 3.881%, yield on cost at 4.126%. And this is what I'm focused on. That's why it's circled over here in the red. The passive income provided by all the positions in the portfolio continues to grow, whether the market's up, whether the market's down, whether the market's floating sideways, whether I add new capital every week or not. And it currently sits at $12,527.04. And this should go up more next week as we get more dividends into the portfolio and as I add new capital. Now, eventually I'll turn off the drip and be able to use this to pay some bills. I have a plan in my portfolio where I am only ever going to pull out 70% of the dividends and reinvest the other 20 to 30%. I may throw some of it into savings, but it will never be less than 20%, and I'll never pull out more than 70%. So when I do turn off the drip, I will allow myself to pull off 70% to use for bills or reinvestments or living expenses, whatever I'm going to use it for. 20% at a minimum will get reinvested back into the portfolio, and 10% potentially could go into savings, right? So 70% will only ever be the max that I pull out of my portfolio. That's how I am planning to use it. You pick what you want to do for your investing strategy and your future allocations. Dividend growth year over year sits at 6.65%. This will change over time as the companies in the portfolio adjust their dividend payouts. You can start to see some of these have already been highlighted. These companies have already announced dividend raises for 2025. As the rest of them do, I will highlight them. Hopefully, some of the positions like Kraft Heinz that have not been raising their dividends over time will start to do that. Some of the other ones that just started paying dividends, BABA, you'll see a 0 over here for dividend growth. I'm expecting to increase this dividend growth. We'll see if they do. Same thing with Google. Google recently just started raising or paying dividends last year, so that's why there's still a 0 there. I am anticipating them raising their dividends, so hopefully they do that. Now, Kraft Heinz, whenever I bought them, they weren't raising their dividends, so you see a 0 here. I am hopeful still that they will start to raise that again. Same thing with AT&T. I bought AT&T after it dropped its dividend, and the price dropped significantly. As you can see here, I'm up 30.73% because it's about when I bought the position, not necessarily the position itself. I know a lot of people ran away from AT&T when they cut the dividend, but that's the time I bought it. So I've got a very nice raise or a very nice return on this one so far. But I am hopeful that they start raising their dividend again, right? So there's 4 companies that are still at 0 dividend growth that I'm hopeful that they start raising again. 2 of them at 0 only because they've just started recently paying out dividends over the last year. All right, that is really it for this one. Let me know what you bought this year or this week in your portfolio. What did you add to? What positions are you seeing value in right now and trying to build out as the market pulls back? Well, as it maybe turns around and starts heading in the other direction, we'll see where it goes overall. Maybe this is a dead cat, what they call a dead cat bounce. If you don't know what that is, it's a temporary turnaround from a long-term downtrend. We'll see if it is or not. And that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. Let me know what you think of my portfolio. Do we have any positions in common? Again, what are you investing in right now? Where do you see values, whether it's in individual stocks or overall sectors? Love to hear from you in the comment section down below. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you want me to cover a company stock in the Stock Pick of the Day series, for example, go ahead and drop it down below. I'll try to work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money, so never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.